Good morning, and today I'm going to talk about the covered call screener. We have an outstanding set of automated tools that help support the management of a covered call portfolio. So I want to review our covered call screener. We have a toolbox that has lots of easy to use tools, and I'm going to go through the covered call screener with you today. It's an online tool, so I'm going to go into our website, and here's our covered call toolbox. You can see there's a bunch of different tools here in the toolbox, but I'm going to discuss our covered call screener. A covered call is buying a stock and selling a call option against it. Now, we use a covered call so that we can generate monthly cash income against our stock positions. All of the compound stock earnings techniques are designed to generate cash income inside a portfolio. So the covered call, the way we use it, is like renting a house. You buy a house, or in this case a stock, that's your asset. Then you rent it out on a monthly basis. The rent you collect is your desire for a profit. You're not trying to profit on buying and selling the house, you're renting it. That's how we look at covered calls. We buy the stock and then we rent it out with the call. So we sell a call option to a speculator who's out there hoping that the stock is going to go up, but we're going to generate income whether the stock goes up or not. Therefore, the most important thing is, like buying a house in a good neighborhood, we need to buy a good quality, solid stock. And therefore, we have a screener. And the screener uses multiple technical and fundamental criteria to search through all of the stocks out there on the U.S. market and puts the stocks through the criteria to narrow down the field. And this criteria is there to help improve the probability that it's a good, solid company that's going to stay around and that it has a good chance of going up. So here's the criteria. This is our toolbox, and we have lots of different criteria. We're looking at where is the stock in its 52-week trading range. We don't want to enter a position that's at the top of its chart. We want to enter a position where a lot of other people have already paid more for that stock than we're going to. So we want to make sure that the stock is trading at less than 75% of its trading range. We look at broker recommendations. Now, we don't want to buy a stock just because brokers recommend it, but we look at broker recommendations because other people listen to brokers. And so if we're going to buy a stock, we want the brokers to be our cheerleaders, telling everybody else to go buy that stock. So that helps improve the probability that the stock price will go up. We assign a 1 to 5 scale to the broker recommendations, 1 being the very best, a strong buy, 5 being the worst, a strong sell. That will be our average, and we want the average to be less than 2.6, so it's more weighted towards the brokers saying buy. And we look at the market capitalization. We want it to be higher than $500 million. So we're not buying real small companies. We want the cap to be higher than 500 million. And that's simply the number of shares there are in the company times the rest of the shares. And we want the PE ratio to be less than 36. The lower the PE ratio, the more conservative the position. PE is the price earnings ratio, the price divided by the earnings. And then we want the stock to be at least a $15 stock. We don't want to be buying $3, $4, $5, $6 stocks. $15 stock minimum. And then we have a requirement that the earnings per share growth for next year has to be higher than this year. Of course, next year is a forecast, but it has to be forecasted to have a larger earnings per share next year than this year. That helps the price of the stock go up as well. Then we want the number of analysts that are saying buy this stock to be greater than those saying hold, because really in stock market terms, hold means don't buy it. And if the people aren't buying it, it has less of a chance of going up. We also screen out the companies that are going to be announcing their earnings between the time that we're searching and the expiration of the option that we're going to sell, because we're selling a monthly option and those options expire on the 3rd Friday of every month. Okay, so we're going to be looking in March for the March option month. So we're going to search for positions buying the stock and selling the call for the month so that we can generate monthly cash income against our stocks. And then we have a search for what percent return we're looking for. Right now, there's about 3 weeks to go before expiration, so we're going to be looking at 3%. If there's 4 weeks to go, we look at 4%. So we're always looking for a minimum of a 4% per month return. And so we simply search, and it doesn't take long. In a matter of less than a minute, the computer has gone through all those criteria and placed here 23 different potential candidates. So I'm going to go through the very first one and just try and teach you a little bit of the information. So here's Green Plains, a common stock. GPRE is the stock symbol. The name of the stock, Green Plains. The current stock price is $23.40. So we would have to buy the stock at $23.40. And then we would sell the March 15th $22.50 call. and we would get $1.85 of premium. That's the option price, and that's per share. So we'd pay $23.40 for the stock. We would sell the rights to somebody else to buy the stock back from us at $22.50. It's called an in-the-money option. So we sell near-month in-the-money options to help increase the probability we'll be called out, because being called out is what we want to do. At the end of every month, we would love to just sell all of our stocks, have all of our cash back, so we can come back to the screener and select new positions that are going to generate 4% or more monthly per turn, every time, 4% per month. So for that right, the speculator is going to pay us $1.85 per share. That then gives the speculator the right until the third Friday of March, the right to buy our stock at $22.50. There's the option symbol, number of days until expiration, and then there's the calculation of the return. Okay, what type of return will this position provide us? There's an uncalled return. An uncalled means that the stock closes below the short call strike of $22.50. And therefore, we still keep the stock and we have the $1.85 per share profit. If we divide the $1.85 by the price we paid for the stock, that's the capital we invested. That's a 7.9% return for the 3 weeks of investment. Then we simply sell another option against our stock. And there's a whole other set of tools that are related to that. If it's called out, that means our stock is going to be bought from us at $22.50. So if our stock is bought at $22.50 and we paid $23.40 for it, that's going to leave us 90 cents out of our $1.85, that $1.85 premium that we received when we sold the call. That still leaves us a 95-cent profit. So 95 cents then divided by $23.40 is a 4.1% return. So we're either going to make 4.1% if the stock is above $22.50, and it is right now, it's at $23.40, or if the stock goes below $22.50, our profit will be 7.9% and we'll still own the stock. Now, if we click on the stock code right here, we have what's called our stock researcher box. It comes up, and this is all the data that you can see the answers basically to all the screener criteria. Earnings per share, our forecast would be growing next year, broker recommendations less than 2.6, there's 3 strong buys and only 2 holds, the market cap is over 4.99, the stock price is over $15, the PE ratio well less than 36, sitting on 11% of its 52-week high. And we also use this to find out what industry the stock is in, because diversification is really important. And then there's the earnings per share. So that is how we go through the screener. And there's a little bit more to learn for the process, but you can see that we have a very sophisticated online tool that picks through the search criteria and makes it a very fast process. And thank you very much from Compound Stock Earnings. Thank you for listening. And if you want to learn more, all you have to do, just sign up for our free Tuesday night webinars. They're held every Tuesday night from 7 to 9 p.m. Central Time. Just go to compoundstockearnings.com to sign up for that free webinar. Thanks.